Welcome to The Explainer. Today, we're going to completely demystify central banking. Now, to really wrap our heads around the Federal Reserve and international monetary policy, I want you to imagine the global economy as this massive, highly complex agricultural system. For the crops to grow, the system needs a constant, steady flow of water, which in our case is money. If there's way too much water, you get a flood, right? That's inflation. But if there's too little, the crops just wither and you get a recession. Central banks are basically the ultimate water management boards. They control the valves.
All right, let's dive right in. Here's our roadmap. We'll hit the Fed's structure, their three policy valves, and their massive balance sheet. Then we'll look at how they target the economy, how they navigate real-world crises, and finally, we'll cross the Atlantic to check out the European Central Bank. Section 1. The Fed's structure, the Water Management Board. Established by Congress way back in 1913, the Federal Reserve is the independent central bank of the United States. And there's a really crucial number to understand here, 14. The core leadership of the Fed is the 7-member Board of Governors based in Washington, D.C. Each member is appointed by the U.S. President, but get this, they serve a massive, non-renewable 14-year term. 14 years! Why? Because the system is specifically designed to totally insulate them from short-term political pressure. They literally do not have to worry about artificially juicing the economy right before an election. They can just focus on long-term stability.
Now, beyond those 7 governors, the Fed has 12 regional Federal Reserve banks. Think of these as the boots on the ground. The New York Fed, for example, is arguably the most crucial because it directly handles Wall Street and the markets. Together, the system performs 4 huge duties: conducting monetary policy, supervising banks, maintaining financial stability, and providing banking services to the government itself. But the real magic? That happens at the FOMC, the Federal Open Market Committee. This is the ultimate policy-making body. They meet at least 4 times a year, and they pore over a document called the Beige Book, which is basically a giant summary of economic conditions across all 12 districts. They use that to decide if the economy needs more water or less.
Moving to Section 2. The 3 policy valves, controlling the flow of money.
So how exactly does the Fed actually move the needle? Well, they rely on 3 main tools. The first, and honestly by far the most important, is open market operations, or OMO. Think of this as the main valve. When the Fed wants to pump water into the system, the trading desk at the New York Fed literally buys U.S. Treasury securities from banks. They're just swapping bonds for fresh cash, which immediately floods the banking system with reserves. The second tool is the discount rate. That's basically the emergency spigot, where banks can borrow directly from the Fed at a set interest rate. And finally, there are reserve requirements. These are the reservoir rules that dictate exactly what percentage of customer deposits a bank must actually hold on to rather than lending out.
The crucial thing is how they twist these valves. If the economy is looking sluggish, the Fed uses expansionary policy. They buy securities, they lower that discount rate, and they decrease reserve requirements. It waters the crops, you get a higher money supply, lower interest rates, and generally higher security prices. But if inflation is raging and things are overheating, they flip to contractionary policy. They sell securities, raise rates, and increase reserve requirements. This drives up all that excess liquidity, making money much more expensive to borrow, which inevitably slows the economy down.
This essentially kicks off a massive 3-step plumbing reaction. Step 1, the Fed adjusts those policy tools we just talked about. Step 2, those adjustments hit operational targets in the financial markets, immediately altering bank reserves and the Fed funds rate. And step 3, those market changes ripple all the way out into the real world to achieve the Fed's ultimate macroeconomic goals, which are stable prices and full economic growth.
Section 3. The expanding balance sheet, building a giant warehouse.
Now, for decades, the Fed managed this entire plumbing system with a relatively small toolkit, but recent history has forced them to scale up in a way that is just staggering. Take a look at the sheer explosion of assets. Back in 2007, the Fed's total assets, their warehouse of bonds and securities, sat at a baseline of about $951 billion. Fast forward to 2008, the financial crisis hits, they unleash quantitative easing 1, and bam, it jumps to over $2.2 trillion. By the time the COVID-19 pandemic hits in 2021, QE4 pushes the Fed's balance sheet to a mind-bending $8.91 trillion, almost $9 trillion. They were buying up Treasury and agency securities at a completely unprecedented pace just to literally save the financial system from collapsing.
Section 4. Targeting the economy, the master valve.
Okay, with all these tools and literally trillions of dollars, how do they actually aim the fire hose? Well, there is an absolute golden rule in central banking. The Fed can successfully target either the money supply or interest rates at any given moment, but never, ever both at the same time. It's impossible. If you target the raw quantity of money, the price of that money, the interest rate, has to be allowed to fluctuate freely. And since July of 1993, the Fed has firmly chosen to target the interest rate, specifically focusing on the Fed funds rate as their absolute master valve.
So how do they know where to set that master valve? They use something called the Taylor Rule as their GPS. This guideline mathematically suggests that short-term interest rates should be determined by looking at three specific things: where actual inflation is right now compared to the Fed's target, how far the economy is above or below maximum employment, and what the baseline short-term rate needs to be to hit that full employment mark. It's the formula that basically brings order to the entire plumbing system.
Section 5. Navigating global crises, floods and droughts.
All of this theory is great, right? But let's see what happens when the pipes actually burst in the real world. If we contrast the two defining financial disasters of our time, it reveals a fascinating shift. In 2008, the crisis was entirely internal. The banking system itself was broken. The Fed's main objective was to restore banks' solvency, using tools like TARP, which were direct capital injections to recapitalize the banks, and buying up toxic mortgage-backed securities. But 2020, totally different. That was an exogenous shock. The pipes weren't broken, the world just turned the water off. The main objective was preserving liquidity. The Fed didn't need to save the banks, it needed to support the entire system, buying government and corporate bonds just to keep credit flowing. And the sheer scale of that 2020 response is incredibly hard to overstate. The Fed basically acted as the market maker of last resort. They didn't wait for banks to fail, they used unlimited quantitative easing preventatively. They expanded their balance sheet by roughly 110%. They added $4.7 trillion to ensure that global markets simply didn't freeze up. It was a completely unprecedented blanket of liquidity.
Let's turn our attention globally for Section 6, the European Central Bank, the neighboring plantation.
While the Fed manages the U.S., the ECB handles an entirely different beast across the Atlantic. Established in 1998 and headquartered in Frankfurt, Germany, they manage the euro. And the differences between these two are profound. Think about it. The Federal Reserve deals with one single sovereign country and a highly market-based financial system where policy flows heavily through capital markets. The ECB, however, oversees a multi-country monetary union of 20 distinct nations. Their financial system is deeply bank-based. And because they have 20 different sovereign governments, each with totally different spending habits, like, say, Germany versus Italy, the ECB's most terrifying nightmare is something called fragmentation risk, where borrowing costs diverge wildly between member countries. Because of that nightmare scenario, during COVID-19, the ECB had to act as the ultimate anti-fragmentation stabilizer. They deployed PEP, the Pandemic Emergency Purchase Program, which allowed them to flexibly buy bonds exactly where they were needed most. They expanded their balance sheet by roughly 85 to 90%, a massive increase of 4.1 trillion euros. And they utilized TLTRO3, providing incredibly cheap long-term funding directly to banks. All of this was designed to ensure the euro area stayed totally cohesive and a sovereign debt crisis was completely averted.
But then, just as COVID faded, Europe got hit by another massive shock in 2022, the Russia-Ukraine war. This triggered an absolute explosion in energy prices. Unlike the demand issues of COVID, this was a severe, supply-driven inflation shock, and it peaked at a brutal 10.6% across Europe. This created an agonizing triple dilemma for the ECB. They faced sky-high inflation threatening their credibility, incredibly weak growth risking a severe recession, and the realization that raising rates to fight the inflation could immediately trigger sovereign debt stress for their weaker economies.
While they had no choice but to act, the result was literally the fastest rate hiking cycle in the ECB's history. In mid-2022, their deposit facility rate was actually negative, sitting at minus 0.50%, but they violently slammed the valves shut. They ended their ultra-easy asset purchases, and by peak 2023, that rate hit 4.00%. They transitioned from negative rates to highly restrictive policy in barely 14 months. It was breathtaking.
But you might be wondering, how on earth did they hike rates so aggressively without blowing up the weaker Eurozone countries? Well, they invented a brand new tool, the Transmission Protection Instrument, or TPI. This was essentially their magic wand. It allowed the ECB to specifically target and purchase bonds from stressed nations, preventing their borrowing costs from spiraling out of control relative to stronger nations like Germany. It ensured that, while they were fighting inflation with higher rates, the fundamental monetary plumbing of the Euro Union simply didn't fracture.
To wrap it all up, the core takeaway of this explainer is actually pretty simple. The Fed and the ECB are literally the world's ultimate shock absorbers. Whether it's a total collapse of the banking system, an unprecedented global pandemic, or a massive supply chain and energy shock driven by war, these central banks use their highly complex plumbing tools to keep the global economy from either drowning in inflation or drying up in a recession.
So I'll leave you with this final, somewhat provocative thought. We've seen these central banks expand from relatively small operations to multi-trillion-dollar market makers, literally inventing tools like quantitative easing and the TPI completely on the fly. When the next unprecedented, unthinkable crisis inevitably hits our global agricultural system, what entirely new tools are central banks going to have to invent to keep the water flowing? Thank you so much for joining me on this explainer. Keep asking those big questions, and I'll catch you next time.